To Dementia-Friendly Prince George's County, Maryland Northern Sector webinar series for caregivers. Today's topic is wealth management for entrepreneurs and business professionals, presented by Jim Henderson and sponsored by the Prince George's County government and the Department of Family Services. Good evening, everyone, and welcome to the Dementia Friends of America webinar series. We are so glad you are joining us tonight to learn more about dementia awareness and how we can build a more supportive and informed community. My name is Cesar Herrera, and I am honored to be here on behalf of Dementia Friends of America and our local DFA Northern Prince George's County initiative. Tonight's session is part of our ongoing effort to increase understanding, reduce stigma, and provide meaningful resources to individuals, caregivers, and professionals impacted by dementia. Before we begin, I wanted to share an important opportunity with everyone. In partnership with the Alzheimer's Foundation of America, we are offering free confidential memory screenings for adults who would like to better understand their cognitive health. These screenings are one-on-one, they're private, informational, and a caring first step. And remember that this is not a diagnosis. Screenings are available at 15 Crescent Road, Greenbelt, Maryland, starting Tuesday on February 10th from 9 a.m. to 2 p.m. And if you want to schedule an appointment with us, please call me at 241-0037. And remember that early detection and awareness matters, and we encourage you to take advantage of this free service or share it with someone who you think will benefit from it. We also invite you to consider becoming a dementia friend. Through a short online training, you can learn how dementia affects daily life, how to improve communication and support skills, and how to help create a more inclusive and understanding community. It only takes a short time to complete, and you'll receive a certificate upon completion. And you can register at dfaamerica.org/become a dementia friend. Questions in the chat at any time. Now let's begin tonight's presentation. Jim, I will pass it on to you now. You're welcome to start.
All right. Good evening. Can everybody hear me? All right. I'm assuming so. So, hello, everybody. Before we get into our presentation, let's warm up with a little text brain teaser. Let's talk about Bill. Bill is somebody that could be you. Once you're retired, you wanted to have fun. And Bill is 63 years old. He's retired. Now he's going to go to a lot of concerts that he didn't get a chance to do when he was younger. So let's see what kind of money he has available.
Okay.
He has $58,000 in taxable income, which includes $37,500 of Social Security benefits. As you can see, Bill, $58,000 of taxable income puts him in a 22% tax bracket because it's more than $50,000. If we look at the slide on the right-hand slide part of the slide, you can see he's in a 22% tax bracket. So toward that end, Bill decides to take $1,000 out of his IRA account. And let's say he's going to see the Beyonce concert. And so he takes $1,000 out of that account. Uh-oh. Many minutes, Cesar. There we go. So how much tax did he owe on that $1,000? So he pays 0.22 cents in federal dollars for every additional tax dollar. Therefore, if he took $1,000, he should owe $220, right? Wrong. he actually owes $407 in tax. That's a 40.7% tax bracket on that income. And so I will tell you why that happened. And that's the whole purpose of this presentation, is that you have to watch out for Uncle Sam getting you at the end of your lifetime as you continue to live your life. So welcome to how tax planning changes through 4 stages of retirement. I thank you for coming out and learning more about taxes and retirement. I'll assure you that this is just all about its informational purposes. I am Jim Henderson. I give these seminars as part of my ministry. I'm a member of the Senior Providers Network. So I do things on Social Security planning strategies. I do retirement planning. I do IRA planning. I do healthcare planning, cybersecurity, and late stage college planning, among others. My goal is to inform you and educate you so that you can understand how critical financial planning topics affect you and your family. I do this presentation because I've seen so many people make so many mistakes and pay more taxes in retirement than necessary. When that happens, it makes my job harder because people have less income in retirement, and we have to find ways to make their portfolios last. So this is all about helping you planning so that you won't have to give more money to Uncle Sam when you don't have to. So one of the things that you should always be able to do is to make sure that you seek tax professional guidance. Don't listen to the person in the barber's chair or the beautician's chair, because they may or may not be qualified. And also, everybody's situation is different. You know, your household is different from your sister, your niece, or your nephew. So, but be sure to get your information from a qualified source, because we're talking about taxes. You know, there's traditional IRAs, which are tax deferred. I used to tell my clients a long time ago about tax deferred accounts. They heard what went in their ear was tax free. But now tax deferred is the true thing, because deferred means at some point the chickens will come home to roost and Uncle Sam is going to get his. There's something that's called Roth IRAs, which means that your money will grow tax free. And then when you withdraw the money, it's also tax free.
Right. As long as it's 55 or older.
Right. So state taxes, don't forget about that. That's altogether separate.
Right.
So welcome to the new complex world of retirement planning. Because the 2017 tax cut, so-called tax law, presented a big problem for us. Those of us who in the past, we could do a lot of itemizing, we could write off a lot of things, but after 2017, we were subject to what is called the SALT restriction, S-A-L-T, state and local taxes. So that means that we could only write off $10,000 in state and local taxes. Well, that means that the money that you had put aside for state taxes, that may be more than $10,000 all in itself. And then what about your property taxes that you have on your house?
Right.
That may be more than $10,000. So therefore, we were sort of cut off. Now, this last tax cut law that came last July got rid of the restriction and some more things that it did. including the $6,000 difference. So now more of us can do itemized taxes to take advantage of that kinds of things. Then I'll explain more as we go as to what happens to our tax problems as Uncle Sam. So, okay, so what's the first thing we need to understand about retirement and taxes? Key one, start with the end in mind. You have to know what your after-tax savings is going to be and what that picture looks like well before you retire. So if you're already retiring, this could be helpful. But if you're 10, 15 years prior to retirement, this is going to be some special information for you. So if you knew that let's say if you have been fortunate enough and diligent enough to save $500,000 in your 401k, guess what?
What?
It's not really $500,000. It's about, if you're in a 22% tax bracket, it's worth about $390,000. So at the end of this presentation, I have a web link. I have a link that you can determine your own tax debt burden that helps you determine basically how much money you really have in your tax, your IRA or your 401k.
Right. Oh, okay.
So I remember when I was a youngster helping people to accumulate money, I would talk about, helping them putting the money into a tax deferred account. And the tax deferred account will be worth more than the taxable account. And so, but the value of the after-tax value will be much less than the pre-tax value at the end of the time frame. So next question, you would say, well, okay, at least I have Social Security to supplement my income and my Medicare to pay for my health care costs. But hold up. Social Security and Medicare have their own tax traps,
Yes.
and we need to plan for them. Social Security and taxes. Let's look at Social Security and taxes, because a lot of you probably never realized that Social Security had a tax implication. So now let's go back to Bill. Their first slide, we talked about how Bill had, he's paying 40.7 instead of 22%. So let's see what happened. His $45,000 in IRA income, part of his adjusted gross income, he was making a total of $65,538. So he has $37,500 in Social Security benefits. So we put that into the 22% bracket. Yet when he took out that $1,000 IRA distribution, he got hit with a nearly 41% marginal tax rate on that $1,000. So now let's break it down to see what that $1,000 really cost him to go to that Beyonce concert. So here's what's happening. That additional $1,000, it increased his adjusted gross income and his taxable income by $1,850. That means for every dollar of his income that he actually received, he's being taxed on $1.85. Huh? How? Well, here's the deal. Depending on how much other income you have, the amount of your Social Security benefits that are taxable varies. You could be taxed up to 85% or zero, depending on how much of the other money that you're making. So So you could be adding more income to your adjusted gross could actually increase your Social Security taxability. So Bill finds himself in the latter scenario. At his current income for his concert trip, for every dollar that he takes out of his IRA, he not only has to add $1 of IRA money to his taxable income, but he must add an additional 85 cents on Social Security benefits.
Oh, okay.
And if you add that up, that $1.85 taxable to his 22% tax rate for every dollar of additional IRA he actually receives. So if you do the math on that, it comes out to a 40.7% real tax rate
Yeah.
on that additional $1,000 income. That's what we call the Social Security tax torpedo.
That's what you
What I
do.
do for my clients, is that I do what is called bracketology. I manage their brackets. So whenever they want to do a rollover or Roth conversion or something like that, I have to make sure that they don't go into a new bracket to cause them more taxes.
Mhm.
So let's talk about some more. Now we said that was just Social Security. Let's deal with the Medicare taxes. So far we've been talking about Uncle Sam.
Mhm.
Now we're talking about Aunt Irma. So who's she?
Mhm.
Aunt Irma is sometimes more pernicious than Uncle Sam. It stands for income related monthly adjusted amount. The emphasis is on income because it's a monthly tiered surcharge, which means it's a tax that is tacked on to people's Medicare Parts B and Part D
Mhm.
premiums.
Oh.
But it only happens if you're single and you have $109,000 for this year, and if you're married, $218,000. Now you say, well, I'm not in that position right now, but you could be by the time you retire. Because sometimes if you're fortunate enough to do your investment, your retirement might end up putting you in that category. And so you have to be careful. Whatever sometimes it's not how much money you have, but it also might mean is where you have your money
Right.
that will have an impact on how much taxes you pay.
Mhm.
Let's take a look at George and Mark. They have they're high earning couple.
Okay.
They're both Medicare Part B and D participants. IRMA surcharges affect their incomes 2 years prior.
Mm.
And this couple was on track for $342,000 of modified adjusted income. So they were doing all right.
Mhm.
But in December 2024, George decided to sell stock, and that he bought for $10,000 in 2007. He sold the stock for $11,000. So that means his gain was, guess what? $1,000. So he's now taxed at the 15% long-term capital gains rate. Long-term means that if you have any situation more than a year is long-term, less than a year is short-term. I'm getting a little bit in the weeds for taxes now,
Mhm.
because long-term you can't write it all off at once. I mean, long-term you can write it off at once, but short-term you can only write off $3,000 at a time for short-term. So, but anyway, but in his case, is long-term. Now, since they're making $342,000, they have another tax. They have another surtax that comes up because their modified adjusted gross income exceeds $200,000 for singles and $250,000 for married couple. They made $342,000. So George and Martha owe an additional $188,000 on that gain for the 18.8% of the $1,000. But then again, let's take another look, because it means a little bit more than that. Remember, my definition of tax is any cost that increases as your income increases. So there, George and Martha will owe more than $188 because the gain from the sale of their stock pushed them off the Medicare IRMA cliff
Oh, okay.
into paying higher Medicare premiums. Let's take a look. I love to show this slide because this is my Aunt Irma. I call it, you know, Uncle Sam you pay income taxes to.
Right. And
And the Irma taxes, I call her Aunt Irma, Uncle Sam, Aunt Irma. And she's worse than anything. So look at it this way. So if you're making $109,000, okay, if you make $109,001, you will have to pay an additional 280. Well, she would have to pay an additional $81.21 per month
mm,
if you're single. If you are married and you make $1 more than the 218, then each couple, each partner in the marriage will each owe an additional $81.20. And so in George and Martha's case, they're gonna owe $324 a piece for that $1,000.
man, that's good though.
So in other words, what we're trying to do, and what I'm trying to get you to see is the perniciousness of Aunt Irma and what it's going to cost. Adding those Irma charges together, George and Martha will each owe $146 a month, or more than $3,470 of combined additional charges for the year, as long as that year lasts. So that Irma stock is going to cost them a whole lot of money through their time frame, just because they happen to sell that stock to get $1,000. That $1,000 is going to cost them $3,600. Okay. Now, Medicare. Let me remind everybody about Medicare. Remember, Medicare only covers 80% of your health insurance. Health, yeah, your health costs, put it that way. You should, at age 65, the 3 months before you turn 65 and 3 months after you turn 65, you roll in Medicare. And if you don't do that during that period, you will be penalized for life. So now there are some people who feel very comfortable with the health program that they had when they were working. That's fine. But if that health care changes or that company goes out of business, oh, and by the way, that company where you worked at must still have at least 20 employees working. So if those 20 employees working, even though you may have health care through that company, it is not considered what they call credible coverage. And so you have to enroll in Medicare Part B. Now, Part A, by the way, is free, but Part B, you have to pay for it. So to help you understand, let's look at Jim and Ann. They're both 68. Jim retired at age 65, Ann retired at 66. Prior to their retirement, they had a health insurance through Ann's employer, and they continued that after Ann retired because her employer offered pretty nice health benefit. Okay. Unfortunately, they didn't know that they had to enroll in Medicare Part B as soon as Ann retired. Even though Ann's employer offered retiree health insurance benefits, those benefits were generally paid secondary to Medicare after retirement. But Jim and Ann didn't realize the mistake until it was too late. And thanks to the way Medicare enrollment periods work, they weren't able to begin coverage until the next year. So they was out there, sitting there, waiting for nothing to, hoping that, praying that nothing would happen, that they will have to be spending money for their health care. Worst case scenario, this would have resulted in a gap coverage for Jim and Ann if they had a major medical need. But even in the best case scenario, because Jim and Ann missed their deadline to sign up for Medicare Part B, they will each owe a 10% Medicare Part B premium penalty for life. So you can see how much that translates into real dollars. They owe $486.90 extra in 2026. Historically, we can estimate that that premium will be higher, so that 10% penalty will grow and grow and grow and grow. Over the course of their lifetime, it could be about a $10,000 mistake for that couple. For simplicity's sake, let's assume that Ann's retiree health insurance covers prescription drugs, so that they didn't sign up for Part D. Just to know that there's a penalty as well. So now, what are those other tax traps we will face in retirement? I know y'all saying, Mr. Henderson, you're getting us too much involved in taxes we didn't know anything about. So my key number 3 is you got a plan. How and when you use your taxable, your tax deferred, and your tax-free assets. You can't be haphazard about tapping into your tax deferred savings. Timing is everything. You have to do this bracket management, you know, and they say brackets and mid March Madness. They're talking about brackets. Well, we got tax brackets that you got to be concerned about. So let's look at addressing those specific problems. One way to help manage your account before and during retirement is to utilize Roth IRA conversions. A Roth IRA conversion is a simple process that allows you to move money from your IRA or your 401k or whatever, your 403b or your 457, whatever plan you have that was tax deferred, to a Roth IRA. In general, the amount that you convert to that is added to your income for that year would be taxed at your rate. So if Jill converts $100,000 from her IRA to a Roth IRA, she would have to pay the taxes on that $100,000. But from that point on, all the money in that Roth then becomes tax-free. And so what they have to do is to do what I call bracketology. In other words, got to make sure she might not be able to go and complete the whole $100,000 because that might take her from the 22% tax bracket to a 24% tax bracket. That might not happen. So if you're thinking about doing a Roth conversion, you not only consider talking to your investment advisor. Your investment advisor may not know a darn thing about taxes. All he wants is to get your money. And so what you want to do is make sure that you talk to your tax advisor before you make that decision. Now, I'm telling my clients, especially the ones who are below 60, that they should don't put all their eggs in the 401k basket. What you want to do is get the free money. The free money is in every scenario almost, the company will have a matching amount. So you want to put enough money in there to cover all the matching. So if your company says that we will match you 5%, then you put 5% into there. Now, you can actually, some companies will allow you to put 10%. The maximum you can put into your 401k is about $26,000. So if you can do 5%, which is, let's say it's $5,000, I would say match that $5,000 and buy a life insurance policy. Why? Because every money that comes out of the life insurance policy is tax free. It's your money. And not only is it tax free, is that the life insurance policy has living benefits. That's why they call it life insurance. A lot of y'all think about life insurance as death insurance. That's what term insurance is. You only get the benefit when you die. Well, you don't get the benefit, your beneficiaries get the benefit. So that's what I call that is death insurance. That's term insurance. Only pays when you die. Now there are some life insurance companies that offer the life programs, such as chronic illness riders, critical illness riders, and terminal illness riders. The insurance company states that we don't care if you got a $500,000 death benefit, then if you need to spend this money on your care, let's say you do come down with Alzheimer's or something, but you need 2 of the 6 ADLs, then you can pull that money from your death benefit. And as long as you leave about $10,000 to bury you, that's the way it goes. So that's what I try to help people do, is make sure that they handle the right kinds of money at the right time. There's something else called a health savings account. Self-savings account, for a lot of companies are offering that now. It's a high deductible plan. Usually, if you're one of those people who don't get sick very often, then the health savings account go along with what is called a high deductible. That means that your deductible is, you pay that first before the insurance company kicks in. But if you don't get sick that year, then you're good to go. And then that money goes into this plan. And if it could grow, it grows tax free. And at age 62, whatever money is in that account, then you can spend that money on things other than health. It then becomes a nice little retirement money. Okay. Now, if you are a business owner, there's something called a qualified business income. That came out with the 2017 tax law. Individuals pay 39, well, they went from 39% highest to 37%, but a C corporation pays 21%. So the QBI, qualified business deduction, will put individual owners at the 28% tax bracket, but only certain businesses are allowed to take the full advantage of it. And one type of business is rental real estate. It automatically satisfies itself as a QBI. Now, I have 2 practices. I have a tax practice and I have an insurance practice. My tax practice is not qualified above I think it's $325,000. But my insurance practice is covered, no matter how much money I make in the insurance business, is qualified, and the amount of money I make is only at the 28%, whereas my tax practice is at the 37% because it flows through to me as an individual. So that's one of the things that business owners should be concerned about, is determining what it is that they're doing in their business and whether or not it qualifies for QBI. The other portion that we're talking about that's a tax indication is the charitable giving scenario. You can, and those of you who have retired or nearing retirement, you may have heard something about RMD. That means required minimal distribution. And if that's the case, then you probably at a situation where you really don't need the money. You're doing okay. Thank you very much. You did a great job in providing for your retirement. And now Uncle Sam wants to tax you on money that you saved. And you heard that guy named Henderson told you that it was tax-free. But what he did, he told you it was tax deferred, but you heard tax-free. And now the chickens are coming home to roost. Well, you got to pay taxes on that money based on how much it was December 31st last year and how much, what your age is. And there is a calculation that they use. But there's a way around that. If you gave the money to your favorite charity, then you would not be taxed as if it never happened. Let's show you. I'm going to show you how that works. This thing is called a QCD, Qualified Charitable Distribution. You have to be 70 and a half to take advantage of it. But that's about the time the people start thinking about RMDs. And so it goes, but what you have to do is it has to go directly from the place where the money is to the charity where you want it to go. You can't cross your hands. I mean, especially nowadays that you can't do too much to qualified distribution. What's the word I want to say? Your Schedule A, itemized deductions. You won't have to do itemized deductions to get it. So in this case, you do not want your RMD to count as taxes. If you give it directly under the auspices of a QCD, then it's as if it never happened. And so let's say if you normally give $10,000 to your church or any other charity, such as the Alzheimer's Association or whatever it is, what organization you love to give money to, then you give that money directly from your IRA to that organization, and it doesn't show up on your taxes. So, and I've seen people will tell me that they have done that, and I believe them because there's no paperwork that comes out. It just you just do it, and the holder of your money will send some kind of a record of that you have given that money that way. So you can save a lot of money through the QCD. So what happens when you die? Well, because we're all going to do that. This is it. Taxes and death, those are two things that will happen to all of us. Well, since that's going to happen, so let's plan for it. Most people don't like to plan because it's about death, right? So, but let's look at pre-death, which is long-term care. Back in the day, back 10, 20 years, 25 years ago, there was something called long-term care insurance. And back then, it was use it or lose it. You paid your premiums, and they told you that the premiums will never go up. But then 30 years later, the premiums are going up, and now a lot of people. I have a unfortunate situation, and my family, former family member of mine, had the long-term care when the premium went up, she dropped it, and then a year later, she came down with Alzheimer's, so she had no coverage. So that could be a situation you don't want to avoid. But remember me telling you a few minutes ago about life insurance. A lot of life insurance companies are offering chronic illness care. So that's the benefit. And I was telling you about, don't put all your eggs in the 401k basket. Then if you start putting that money into a life insurance policy, that may cover a lot of your cost. Even if you had long-term care insurance, it will not pay for everything anyway. So if you have a $1 million life insurance policy, that will pay for 6, 7, 8, 10 years. And usually, if you need help in 2 or 6 ADLs, you probably won't last that much longer than that anyway. So this is something to consider. Looking at the life insurance and long-term care hybrids to help cover that cost. And it's something that we should all take a look at. And you're probably wondering right now about, my goodness, how in the world can we ever manage all of this that Mr. Henderson is talking about? Well, I mean, basically what you have to do is just take a look at where you stand right now. Take a look at managing the money that you have. Look at where you want to be when you retire, what you want to do upon retirement. Do you want to party? Do you want to go travel? Do you want to play golf? Most of us who are retired already, we don't want to sit around and just do nothing. And so basically you have to set aside some money. Sometimes some people who not have a progressive outlook on life, they will say, well, suppose I die. Well, I'm saying, suppose you live. So you have to plan for what if you live. And then let me tell you, as a member of the retirement community, living in retirement is just as much fun as it was when I was in my 20s. So because all of the things that you have been exposed to, you do need a tax strategy. You have to anticipate where your money is going, where your money is, and how you will utilize it. So the whole concept of this presentation is to prepare how the distribution works, because I'm sure that you're trying to figure out how to accumulate the money, but you got to think about the distribution of the money as well. Mistakes can be very costly, and I, as a tax preparer, I see it every month when I'm doing taxes.